Watch this video if you want to build wealth and get rich with the upcoming week's market outlook. So ever since April 2nd, which is now called Tariff Liberation Day from the administration, the market outlook has been turbulent. There's been fear, uncertainty, doubt, anxiety, and some market insiders say that this is the worst that they've ever seen, even worse than the COVID market sell-off. This coming week is going to be very big for the markets because it's earnings season, and so you have a lot of top U.S. companies producing their earnings reports, which you can monitor that on CNBC. They broadcast it, and so these earnings reports are going to be definitely fundamental to the direction of the market. You have some companies that are so large, they can impact the market one way or another, the entire market. And so this week is going to be an important week. Definitely be paying attention, because obviously, you want to position yourself correctly. And for us, productive consumers, we got our game plan. All it is for us is rinse and repeat. We're just doing the same thing that we always do, which if you watched the previous two videos, you already know. Number one, keeping our income up. Number two, keeping our expenses down. So income over expenses. Number three, you're taking what you have left over and you're identifying an investment opportunity with the money that you have left over. All right. So then when you get paid, you're taking that amount of money, right? Whether you get paid every week, you get paid every 2 weeks, and then you're going to take that money and you're going to make your investment. All right. And you already know multiple ways that you can invest that money. You can invest that money in a business. You can invest that money in the stock market. You can invest that money in crypto. You can invest that money in real estate. You can invest that money in bonds. You can invest that money in, bonds is fixed income. Continuing with fixed income, you can invest in CDs through your bank. So a variety of ways that you can invest your money. All right. But the main thing is identifying that investment opportunity through budgeting and controlling your income and your expenses. And what we're doing is we're basically having to navigate this negative sentiment, this negative macro outlook. We have the anticipation of softer consumer spending, which makes sense, because if prices rise and prices go higher based off the tariffs, then people will be more likely to spend less money. You would think, right? But hey, here we are. We're Americans, we're US citizens. What do we do best? Spend money, even when we don't have it. And so that's why, as a productive consumer, we have to get out of that mindset. We have to shift our mindset to producing more and spending less. We're still gonna spend, we're still gonna consume, but we have to shift to being more producers. And so the worries about the tariffs starting to impact the supply chain is, what would potentially lead to higher prices. So yes, impacting of the supply chain is a significant factor, because if these companies, right, these big international companies, which are going to be our companies, they're going to be United States companies. If the supply chain is impacted to the way where it's going to cost them more to do business, it's going to cost these companies more to purchase the materials that's needed to produce and manufacture these products. It's going to cost these companies more on the manufacturing side in these other countries, right? Because a company can't just go cold turkey and say, oh, we're just going to completely halt manufacturing, right? Because if that happens, you're completely halting your revenue. All right, your ability to sell and generate profits. And that's what business is all about. So there's that fear that we're starting to see that disruption in the supply chain. The second thing is the fear of a tariff-induced recession. Okay, so once again, we touched on it already. A recession is where it's marked 2 consecutive quarters of negative GDP. So when they record 2 consecutive quarters of negative GDP, then that's technically a recession for our country and our economy. And so in times of recessions, you know, things get tight. Companies start to spend less. Companies start to make cuts. They start cutting their expenses. The same thing that we personally have to do in our own budgets. All right, keep the income high, keep the expenses low. That's what these companies are gonna do. And so when they start cutting expenses, well, what does that look like? They start cutting jobs, see? And when companies start laying off and terminating employees, then what does that do? That increases unemployment. And so when you get an increase in unemployment, then you have to get a reaction from the Federal Reserve when it comes to the interest rates, right? Because that's what the Federal Reserve can't let happen. The Federal Reserve is supposed to be there to monitor the likelihood of us going into a recession, right? Which could stem from an increase in unemployment due to the supply chain disruption and a tariff-induced recession. So we're gonna look out for the Federal Reserve and how they react with the interest rates. Because if we start seeing the Federal Reserve reduce interest rates, then what does that mean? That means that's gonna lead to what? More liquidity in the market, more liquidity in the country, more liquidity in the world. When we're talking about liquidity, we're just talking about money, the money supply. There's gonna be more money. And with more money, then companies will be able to spend more. But at the end of the day, if you look at the situation, are these companies gonna spend more? No. These companies, they're gonna get more money, they're gonna increase their profits, and they're gonna keep that money to themselves. So a lot of companies could potentially be moving into cash. A lot of investors, a lot of institutional investors moving into cash. But if these companies and these investors move into cash, then that means they're selling assets. And if they're selling assets, that means the price of the assets are going down. And if the price of the assets are going down, that means everything is on sale, right? That makes for a good buying opportunity. Okay, so that's what we have now. We have had for the last 2 weeks up to now, a great buying opportunity. Because see, we're not gonna buy when everybody else is buying. We're not gonna buy when everybody is all happy and excited and the price is increasing rapidly. That's not when we wanna buy. That's when we wanna sell. So like I said in the previous video, those people, you know, that are in the market, that are considering whether they should hold their position or whether they should sell, you should have already sold. See, you should have sold at the top when the S&P 500 was at 6,147 points. That was the high, right, back in February. You should have sold then. So if you've been holding, hey, you might as well hold on, because now you're selling for a loss when you could have sold for a profit. The S&P 500 during the sell-off between February to now dropped 20%. On April 7th, the S&P reached about 4,835. Don't quote me on that. And so a lot of investors, a lot of insiders, a lot of the professionals are considering whether that was the bottom. Did we bottom out there? Because that was down 20% from the high. 20%, the S&P 500, which is the benchmark of the stock market, was down 20%. So for the last 2 weeks, we've already had a hell of a buying opportunity. Okay, were you buying? Did you buy anything? If you've been buying over the last 2 weeks at any point, drop a comment. You don't have to let us know your moves, right? I understand. But let us know if you've been buying. Let us know if you're with us as a productive consumer. You see the writing on the wall. You're able to do the technical analysis. So since April 7th, when the market bottomed out, these institutions, The smart money investors, they've been positioning themselves. They've been taking positions. All right. So what are you going to do? Are you going to start taking your position? Have you started already? You better believe I have. You better believe the productive consumers have. If you listen to some of these talking heads and pundits, they're going to tell you, oh, this is a bear market bounce. There's more pain to come. Okay, that's cool. If it is, if there's more selling, if the fear of a tariff-induced recession is greater than this bounce back, okay, no problem. Guess what? Rinse and repeat. Productive consumers, rinse and repeat. We're buying. We're dollar cost averaging. We're accumulating assets as they get sold off. And what you want to pay attention to going into this week, like I said earlier, is the earnings from these US companies. And so what we want to see is an announcement by the administration of some trade deals. Because even if some of these companies report negative earnings, which could impact the market, the announcement of trade deals will offset that and will kind of confirm that the bottom was put in on April 7th. Okay? And so regardless what happens, you know, once again, dollar cost average, accumulate these assets as they're being sold off. You know, put yourself in a position to be able to hold them for long term. All right. If you need an emergency, something comes up, you need money, you want to have that already put to the side. Okay. If you don't have it put to the side, start putting that to the side too. You know, if you need to split up your investment opportunity that you've realized through your budget, then divide it up. Put some to the side in your bank account for your emergency, and then the rest of it you invest. But you have to do something. You have to do something. You have to make the decision. Now is the time. If you don't make it now, if you're not accumulating assets now, at the time where anybody that knows anything, anybody that's considered a smart investor, smart money, institutional investors, everyone knows you have to be accumulating assets now, or else you're just not in the game. Whether you're buying individual stocks or you're buying the ETFs, like the S&P 500, VOO is a good one, SPY is a good one. I appreciate y'all for tuning in. I'll be dropping more videos. I'll drop consistently on this channel concerning, you know, finance, the economy, the markets. That's what we're talking about here. So don't forget to like, comment, subscribe, you know, give me your take on things. Let me know what y'all think.